Welcome to another episode of Finance Facts and Fictions. So in the previous video we've discussed a little bit about diversification, when to apply it and how to apply it. But I know that there are a lot of investors out there who also enjoy stock picking. So in this video I want to discuss in which scenarios we might be going after diversification, but in which cases it may actually be interesting to go after picking individual stocks. Because there are cases when stock picking may be interesting. But what is key to answering this question is to understand what the risks and returns are related to these two investment strategies. So let's get started. So in the past few videos we've discussed why we want to diversify. But I know a lot of you out there also enjoy stock picking. So in this video I want to discuss whether we should go after diversification or we should also pick some stocks. So first, let's get the definitions straight. We know that diversification is spreading your investments. Now, stock picking is essentially the opposite. It is investing in one or a few stocks. Now, why would you buy stocks selectively? Well, it may be that you think you have unique information about certain stocks that are undervalued, so you're going to buy these stocks in the hope that they're going to increase in value in the future. As a result, you may be able to catch higher returns given the risk. But you do have to wonder about the risks. Do you actually have more information? And does gathering the information outweigh the cost? So can you actually earn a higher return which outweigh the cost of collecting information? But if you're also buying only a few stocks, this will mean that you're less or not diversified at all. And as a result, we know from the previous videos that you have a higher risk, because you still hold some idiosyncratic risk or company-specific risk in your portfolio. But there's another point. You actually also run a high risk that the very best performing stocks are not in your portfolio. And this is something I want to discuss in this video. I already referred to this study from Bessembinder in a past video, but now I want to get into the details of it. What the researcher does is that he compares the stock returns to the returns on 1-month Treasury bills. Now, given the risk-return relation, we should expect that stocks give a higher returns than Treasury bills, since stocks are riskier. Now, what the study does is that they look at 90 years worth of data. Now, over these 90 years, they track all stocks, which are more than 25,000 stocks, over their lifetimes. So this means from the moment that they go on the public market to the moment that they are removed from the public market. Now, this removal may be because the company went bankrupt, but it could also be as a result of a takeover. Now, what Bessembinder then does is he compares the monthly Treasury bill returns, which are as good as risk-free, to the stock returns. And he's just comparing absolute stock returns. Now again, due to the risk-return relation, we should expect that stocks with higher risk also provide a higher return than monthly Treasury bills. And we know from previous studies that indeed a portfolio of stocks outperforms bonds. But what about individual stocks? Do they also outperform bonds? Now let's just imagine that these 25,000 stocks can be illustrated as 20 different stocks. Now what the study finds is that the average return is more than 18,000% over the lifetimes of stocks. Now for Treasury bills, this is just over 100%, which is still a good value, but it's certainly less than 18,000 that you can get over the lifetime of stocks. The research shows that almost 12% of the stocks have a negative return of 100%. Now actually more than half, 50.5% of the stocks have a negative lifetime return. And this just shows you that it's risky to buy individual stocks because half of them could actually have a negative return. Now, if we compare these returns to the returns of the Treasury bills, we find that actually close to 60% of the stocks perform equally or worse compared to Treasury bills. And just over 40% performs better. But this has a clear implication. Investing in individual risky stocks without unique information is likely to perform worse than investing in safe Treasury bills. So if you don't have unique information, but you do want to follow stock picking, then maybe you should think again and go after safe Treasury bills if it's about your expected returns. Now what if we start to look at total value creation instead of returns? Now the total value creation in the stock market was $35 trillion over the sample that was analyzed. Less than 0.5% of the stocks can explain 50% of the net value creation. Now net value creation is the difference between the total wealth being created minus the wealth that is lost from companies that went, for example, bankrupt. So we see that a few stocks performed extremely well. And just over 4% of the stocks explained 100% of the net value creation. So again, just re-emphasizing that a few stocks can explain the majority of the value creation. Now another, just about 40% of the stocks create positive value. So these are actually investments that would lead to an increase in your wealth. But close to 60%, so most stocks, destroy value. Now what if we compare the performance of buying one individual stock versus buying a value-weighted market? Now what we can then see is that almost 70% of the single stock strategies perform worse than the market. And this return has not even been adjusted for risk yet. This means that most of the single stock strategies have a higher risk, but they perform worse than the market, which has a lower risk. So what can explain these findings? Well, the answer to that is positive skewness. The researcher finds that some stocks do extremely well in a month. Now losses are due to a limited liability capped at 100%. And many stocks have little fluctuation, so a few may go up, a few may go down. But we have to consider these stocks which do extremely well. Now the nature of compounding returns in the financial stock market reinforces this effect of skewness over the investment horizon. So the longer you invest, the stronger the effect of compounding will be on skewness. So the results will become more skewed over time. And what are the implications for investors given this information? Well, as an investor, if you do not have unique information, you should use diversification to piggyback on these extreme returns. If we don't know which stock will provide these extreme returns, and we know that this is less than 5% of the total stock market, then we want to use diversification to at least include these stocks with extreme returns in our portfolio. Because if we don't, we might be missing out. And this is also what we find that in many active investment strategies, which just hold a few shares, is that they underperform to the market because they did not include these stocks with extreme returns. Now, if you do have unique information, you really want to use it to buy those shares with extreme returns, because diversification reduces positive skewness, or it smooths out the returns. So in that case, diversification could actually hurt your returns if you know which shares have these extreme returns. And you may want to forego on some of the diversification benefit. Now finally, there's a little bit of a technical point. If your absolute risk aversion doesn't increase with your wealth or assets, then some investors may prefer to hold a few shares rather than a diversified portfolio depending on their wealth. Now to exemplify absolute risk aversion, consider the following case. How would you feel about losing 10,000 euros? And does it matter whether your total wealth is 12,000 euros or whether it's 2 million? Now I think that for most people, losing 10,000 euros is worse when you only have 20,000 euros in your bank account. But if you hold 2 million in assets, maybe you care less about these 10,000 euros. So in this case, absolute risk aversion is actually decreasing with your wealth. So as a result, richer people might be favorable of taking a few bets in order to get these extreme positive returns and take advantage of this positive skewness. But for most investors, especially amateur investors, we want to be diversified because we cannot afford a complete loss. Now there's just one more thing. Do you actually have superior information that you can take advantage of? You have to consider that gathering information takes time and money. Investing, on the other hand, remains risky. And the dot-com bubble might be a nice way to illustrate this. During the dot-com bubble, a lot of companies were highly valued, but when the bubble burst, many companies lost their value. Now in retrospect, we actually know that a few companies have done extremely well. Think about Amazon, Apple, Facebook, Google, and Microsoft. So these are these companies with extreme positive returns which you want to hold in your portfolio. But at that time it was actually difficult to determine or predict who the winners would be. And an example of that would be the company called Pets.com. Right after the initial public offering, it was valued at $300 million. But the company went also bankrupt within 9 months after the IPO. So this is an example where some investors thought Pets.com would be a winner, but it actually went bankrupt quite quickly and all value was lost. So what are the facts and fiction when it comes to diversification versus stock picking? Well, most stocks do not outperform Treasury bills. Given the risk-return relation, this means that most stocks underperform. The fiction is that it is easy to buy the winning stocks. From the statistics, it's clear that the winning stocks are only a few. Less than 5% of the stocks generate these extreme positive returns. And we want to include them in our portfolio, and the easiest way to do that is by holding a diversified portfolio. But closer to the end of the video, we made a final note that it also depends on your type of risk aversion. It is true that some investors might prefer to take on these small bets where they know that the average expected return is actually negative because they're going to lose money in expectation, but they hope to gain from these extreme positive returns from holding a few stocks. So the way that I read this finding means that for most investors it's important that the majority of their wealth, or a large proportion of their wealth, is actually allocated to a diversified portfolio. But there's some wiggle room where you can use some capital, some wealth, to buy individual stocks in the hope that those stocks would be the future extreme winners. And that is okay. And you can expand this portfolio which you use to buy winning stocks or hope to buy winning stocks as your wealth increases. But it depends on your personal case and your personal risk preferences. If you just want to piggyback on these extreme returns, the best thing for you would be to go after diversification. Betting on extreme returns by holding a few stocks should only be done for fun, where you want to compare this to a lottery. There's a good chance that you're not going to win anything, but there's a very small chance that you might become an extreme winner. Alright, so based on this discussion, we know that we should not be putting our entire pension savings into buying individual stocks, because that's just way too risky. The chance of getting these extreme high returns is very slim, but there's an expectation that we would actually have negative returns when we go after individual stock picking. However, there are cases where stock picking may be interesting. Depending on our wealth, we may be able to use a part of our portfolio for selecting individual stocks, in the hope that we get these extreme positive returns. But again, going back to the introduction of the video, the key is understanding the risk-return relation to both strategies. So, I want to thank you for watching. I hope you enjoyed this video. If you did, please hit the like button and consider subscribing to this channel. And also, if you have any questions, do feel free to drop them in the comment section below. I'll see you in the next video. Bye!